Hi, everybody. My name is Preethy Padmanabhan. I'm a CMO, and I've been in 5 different startups the last 10 years. And I also run a podcast called 10x Growth Strategies. I have the pleasure to welcome Anupam Rastogi, managing partner and co-founder of Emergent Ventures. I'll have him introduce himself. Anupam?
Yeah, thanks a lot. Hello, everyone. Good evening. Thank you for taking the time out on a Sunday. My name is Anupam. Like Preeti said, I co-manage Emergent Ventures. We are a pre-seed and seed stage focused venture firm, focused exclusively on enterprise AI since we started, which was 8 years back. Enterprise AI was not cool then. It is now. But our model is really coming in early in what we call pre-consensus rounds before the combination of the market problem and founder before that's really widely appreciated by the world. We tend to lead with conviction at that stage and then work closely with founders, especially in the first couple of years, really helping them get to product market fit, build out go to market, raise downstream funding, and really help them succeed. So we have about uh, 50 portfolio companies, 200 million under management, investing actively out of our fund three. We do about 20 to 25 investments a year, per fund, which is 5 to 7 per year. So relatively low volume, high impact. That's the model. Uh, we are operators by background ourselves at the firm. And that's what we bring to each of the companies that we partner with is really being able to go deep down, help solve complex problems with AI in the enterprise, and then help create lots of value for founders, for our LPs and others.
No, that's fantastic. I think with a lot of entrepreneurs here, that's something you're covering. But before we go into your, how you look at entrepreneurs and what type of entrepreneurs you work with, would love to talk about a little bit on agentic AI. And we've been talking about LLMs earlier on. Now it's agentic AI. So tell us what's hype, what's reality.
Yeah, lots of there is this curse or blessing. May you live in interesting times. That seems to have definitely come true with AI. We are living in interesting times, for better or for worse. And I'd say the way we think of it is you could think of it as three generations of AI. So you have machine learning, deep learning, which started about 10 years back, really hit mainstream with the compute and hardware and all of that. Then you have foundational models, which of course hit real mainstream 2 3 years back. But we started to see the precursors starting about 2017 or 18 when some of our portfolio companies started leveraging those. And now, of course, you have agentic AI, which is stringing together a bunch of different systems, making different calls, and thinking of that as an orchestration system. So you could think of the first wave as the perception and prediction layer. You have the foundational model, which could be the reasoning and generation layer. And then you have the agentic AI, which is the orchestration layer. And in what we are seeing through a lot of our portfolio companies, which are doing well, is that a lot of the value is in the orchestration, especially in the enterprise. The way you're stringing together, taking all of the data from a lot of different sources, unifying it, cleaning it up, pulling it in the right place, into the right context, having the right types of models. A lot of these companies we work with, they have dozens of models of their own for different tasks. They'll have a small proprietary model for some specific tasks. They'll be calling LLMs. They'll have routers between 5 or 7 different LLMs that they can call for certain other tasks, and there'll be 15, 20 of those things. But to your question of hype versus reality, there's of course way more hype than reality right now, and that's part of the job for all of us is figuring out the reality part. And I think in terms of the reality, I do think it's potentially the biggest technological shift ever that anyone has experienced. And to put it in numbers, for enterprise AI, enterprises today have a overall spend about $50 trillion across everything. This is people, third parties, offices, everything combined, $50 trillion. Our estimate is that 10 trillion of that, 20% is this highly inefficient usage of resources, which will map into at least $1 trillion of AI software spend over the next 10 years. So, the 10 trillion will convert into 1 trillion. So they save 90% of that. And that 1 trillion will be appropriated by vendors, which could be startups or larger companies. So that's what's at stake. And we're seeing in a bottom-up manner that happen across whether it's industry functions, sales, marketing, customer service, customer success, HR, operations, finance, or verticals logistics, manufacturing, media entertainment, telecom, financial services, and then in the infrastructure layer. And I think there's going to be dozens of very large outcomes that will be created, companies that we have not yet heard of broadly, which will be potentially, and at all different levels, billion-dollar outcomes, $100 billion outcomes, $1 trillion outcomes. So, but at the same time, I think a lot of money will be lost as well because there's just way too much money going way too early into way too many companies. So I think you have both hype and reality, and sorting through that and really focusing on where the value is what I think all of us are really tasked with here, right?
Wow, I think I literally had a full blown education on AI in like 3 minutes. Like, fantastic. Loved it. And I know Emergent has been very successful in selecting really good AI companies, and you've had really good success there. Now, what I want to talk about is, you have a lot of few entrepreneurs here in the audience. What are some things you look for in companies that you select?
Yeah. So, great question. So, a lot of things, of course. I think it really, if I had to simplify it into, so it's about, founder, market, and product in that order. So, at the stage we are coming in at very early, founder and founding team is, the main constant. The market, the product can and many times changes. Sometimes the market can also change if they have to pivot, but the founder is what's the constant. So that's the person or the team is what we are really taking a bet on at the early stage we are coming in at. But what we're looking for overall is we need to see some possibility of it becoming a really large outcome. And for us, it's basically public company scale, $250 million of revenues in the next 7 to 8 years. And we want to see some realistic path of each company that we invest in to be able to have some potential. And we spend a lot of time really thinking through that. What does that path look like? What kind of customer sets? What could those concentric circles that the company could expand in from this current wedge, let's say, which is maybe smaller? How do they expand that footprint into something larger? How the market might evolve? But of course, not all 25 companies we invest in will get there. If one or two got there, our LPs will be extremely happy with us. So a lot of other companies won't necessarily get there. But what we have actually been fortunate to partner with founders where we have had an extremely low failure rate so far. So we, just being operators of background, we invest in things where we've had 80% companies which are getting to the next milestone typically. And a lot of companies that are succeeding and doing interesting things across different walks of, what businesses do. So I think that's at a very, very high level of what we're looking for: ability to build a big business, a team that has that, hunger and domain expertise. We also spend a lot of time on the softer side of the team. That's one area which I've been an investor for 15 plus years. I was on the startup side for 10 years before that. So a lot of the best founders, if you look at it, we actually studied that as well at one point of time. Some of the largest outcomes in tech, when you rewind back to the seed stage, they were not necessarily, it wasn't obvious from their resume that this is a person who's going to build a 10 billion, $100 billion company. It just wasn't. There were just dozens, hundreds of people like them who were starting companies. So a lot of that difference came out on the softer side in things like, their resilience, their ambition, their grit, their speed, how fast they can iterate, how they can pull people along, employees, customers, investors, and others. So we spend typically, I'd say, 4 to 5 weeks getting to know the founders in different settings. We take them to different meetings with us, with prospective customers, with potential advisors and others. We sit through those meetings and we observe how they're doing. Are they learning? The best founders often, one conversation to the next, you can see that they're already iterating and they have already, their level is continuously going up. And you can see within 4 or 5 week period that they're already compounding. They're already compounding. So there's a lot of nuance to it. We could talk about that for an hour, but I'll just pause there on that one.
Well, that's great. I think the founder piece is very important. Are there any red flags that you look out for when you do this whole due diligence process?
Yeah, I'm trying to think of ones which we can talk about.
All right.
Beyond there's obviously some of the obvious ones,
Yeah.
ethics and being really transparent is one big one. And it represents in different forms. We do a lot of ref checking and back channel checking of what people have said. And then there's always entrepreneurs are optimists. So there's always some level of what they're saying versus, but there's a fine line there. So that is always we feel that there's even a slight breach of that fine line, even if it sounds very attractive on all of the fronts, we just pull out and it's not for us because that's really, really important. Because that just compounds in different ways. So I'd say that's very obvious, one of the biggest red flags that can be there. One other area which, many companies, of course, have multiple founders, 2 or 3 being the most common configuration. So really understanding that founder dynamic is important because I'd say a lot of one key risk factor for companies at an early stage is that founders don't get along with each other. And at some point and it could happen in 3 months or 1 year or 2 years. If it happens in 5 years, that's fine because at that time, if the company is doing well, they can hire executives and it's much more sort of broad based. But in the early days, it's basically those 2 or 3 founders and maybe 2 or 3 employees. So really understanding that dynamic, are they complementary yet cohesive in how they function? Can they function as a team? Do we think they can stand the side of each other for at least 5 years, if not more? So that's another area. If we see signs that, hey, there's some, often you can pick those signs that, they're maybe not really, they just came together, they thought, hey, this is a great idea, and we both want to make a lot of money, let's work together on this. But then there wasn't really other underlying reasons for them to work together. That's another area that but yeah, lots of other ones as well.
No, great insights out there. Right now, the market, the state of venture, it's not the same as what it was 3 years ago, right? Would love to hear your perspective on the current state of venture capital, and then what are some unique opportunities for this year and beyond?
Yeah. Let's say venture is going through, of course, with 2021, there was a peak in terms of the amount of liquidity in the system. So on the venture side, on the LP side, there is natural, course correction that's happening based on that, where a lot of LPs are being more careful, rightfully so, because a lot of funds that got really big very quickly, they haven't been able to return capital. And there's a lot of companies that raise a lot of money, they've not gone public. At last count, there are 700 companies which are at IPO scale, which are waiting to go public. But there've been, maybe like 5 IPOs this year, and maybe there'll be 20 more if we are fortunate. So there's still going to be a big. So I think there's a lot of these structural things which are working their way through the system. So what that means in terms of firms like us, so we are a relatively smaller, our fund size is about in the 80 million range, which we think is a good enough size where a lot of M&A and secondary sales and other things can also drive liquidity. And that's what our portfolio and we have done, is we've had a lot of exits which are driving liquidity back. So I'd say that's one thing we see which will shape the overall venture landscape. And as entrepreneurs are also thinking about who they take money from, I think there's going to be maybe 50% of the venture firms that you see today may not be around 5 years from now, at least as active investors. For venture firms, what happens is you may see them, you may see that they have a website, you may see the people holding a business card. But what happens is you have these funds which last 10 years or more, but they have no active capital to invest in. So they have to continue doing those funds which they've raised previously, but they may not have active capital to invest. So capital may, some of the largest firms like Andreessen Horowitz, General Catalyst, they're turning into corporations, RIAs, and raising all kinds of, they're becoming like large hedge funds. And they actually have some of them hedge funds, they're acquiring companies, they're doing seed, they're doing growth stage, they're doing super growth stage. And then there are smaller firms which are coming in early and leading with conviction. I think some of the middle, which were sort of will sort of clean out over the next few years. So I think we're going to see some of this reformatting. Then, of course, I think the big other activity is around AI, of course. And if you're raising in that space and you have a great idea and relevance, I think it's probably the easiest time to raise capital that I've ever seen, at least at the pre-seed and seed stage. For the right founders, there is just great amounts of capital, and it's a healthy market because there's also tons of founders of very high quality. To just put a number out there, for our firm, the quality deal flow is what we measure. Is the top of the funnel deal flow, which is always very high. But the quality deal flow, companies that eventually get funded, that's grown 3x just in the last 2 years to about 200 a year out of maybe 2,000 or so that we see every year. 200 are very high quality, and that number has tripled over the last 2 years. So lots of great founders, very high quality founders, great ideas, raising, and lots of capital as well. Yeah. So again, that picking and being in the right spot is more important than ever. Uh, I'd say the later stage and growth rounds are still anemic. Those reflect in the numbers that are put out by Carta and others. I'd say Series B and C and growth stage rounds are maybe 50% of where they were in 2021, and they're perhaps on some rounds even lower than where they were before that in 2019. And we are 6, 7 years in. So I think some of this will the macro often the good thing is for founders here the macro often doesn't it does impact you, but as if you are building something that's interesting of value which has truly has potential to be big, I think there's always going to be capital, and right now especially in the AI related spaces there is a lot of appetite in the market.
Yeah. Wow. No, that's great. I think certainly good to hear that the quality of entrepreneurs that are coming in is really increasing. That means there's so much more innovation happening. Let's give more time for audience Q&A. So anybody has any question for Anupam?
What is the sentiment right now in early stage VC regarding how AI can help choosing choosing deals?
Yeah, you mean so the question is about deal evaluation and sourcing potentially for VCs themselves. So, interestingly, in my prior firm, NGP Capital, starting in about 2013, I spearheaded this initiative for data-driven deal discovery. And initially, it was very manual, and then we developed tools in-house. And then after I left, they put a full team around it. So I'd say at the growth stages, I'd say that's basically table stakes. So every firm that's worth their salt is now built really. Some have built proprietary teams with, in some cases, 6, 7, 8 high quality data scientists whose role is to build this proprietary system to discover deals. And they're looking for all kinds of signals of headcount growth and this customer, they acquired this customer, or they presented at this conference, or they got this award. Everything is helping surface these deals. I'd say that at the very early stages, it's an interesting mixed bag. Because at the stage we are coming at, for instance, there isn't enough data points out there about either the founders or the momentum of the company. There isn't momentum. Often there isn't a product. Often there isn't revenue, or sometimes there isn't a product. Often there isn't revenue at the time we invest. So it's much harder to do a good job. And the risk of doing that is that everyone gravitates towards the same small percentage, and they end up indexing upon certain factors. For example, hey, this founder studied symbolic systems at Stanford, so the system. So every investor is chasing that, which is already happening. But a lot of the other founders, like I was saying previously, a few minutes back, we had studied all of these at that time. There were 200 companies of scale. This is 7, 8 years back. And of those, only 10% founders actually fit those kind of, the traditional parameters of the kind of founders that attract capital easily. So the risk with the system at the earliest stages, they will just gravitate towards those. But we are very alert to that possibility. So we keep experimenting with a lot of the systems that are coming up. We take demos, we've taken subscriptions to some of these tools. So far, we haven't found any which does a very good job predicting it. Having said that, it does help in a few other aspects of the legwork in terms of, for example, surfacing interesting founders in the kind of networks that we look at, and in getting introductions, or in processing introduction and deal flow and scoring deals. We are already using a bunch of the modern tools for that, but we want to keep a open, I'd say, channel, and we are very alert to that fact that we want to be open to things which are not surfaced by any deal flow engine, and be able to look at it on a equal footing.
Jordan?
Yeah. So you had mentioned that enterprise is really the target focus. In the enterprise, are there particular sectors that you're seeing that are more interesting than others?
Yeah, for sure. So we like companies which are solving really complex problems in the enterprise. The more complex the workflow, and if the founding team has the capability, we think, along with the technology to solve it, we like that. Uh, at the current moment, we're quite excited about AI going deeper into engineering frontiers, things like robotics, quantum technologies, climate models. So a lot of these are areas where previous generation technology had reached some sort of a asymptote with where things were, and things are of course progressing. But with generative AI, we're seeing a significant upleveling in a lot of these, and other disciplines like drug discovery, material discovery. So we are going deeper into several of those areas, and seeing a lot of entrepreneurs doing interesting things in those kind of disciplines. So any place which has a lot of data, a lot of complex workflows with different stakeholders. So managing workflows through all of that. Uh, we're also seeing a lot of very interesting human in the loop models across different types of verticals and sectors. And we like that. There's been a lot of talk of that recently, but we've been investing in that theme for 5+ years. We have 5 or 6 portfolio companies which have that. Of course, what we want to see is that the human is doing only 5% of the work, AI is doing 95% of the work or more. But the companies, the customers are willing to pay a lot more for these solutions because the human in the loop, who's typically an expert, really raises the trustworthiness of that system significantly. And hence the enterprises are willing to pay a lot more. For example, we have a company in cybersecurity where AI surfaces a lot of the vulnerabilities, but then they have these security experts who review these reports very cursorily based on what the AI has surfaced, but then they certify it, and the customers are willing to pay 5 to 10x more for that versus something generated purely by AI. Because if it's generated by AI, they don't know. They don't know if whether the engineer at their end should wake up at 2 a.m. and start fixing some problem or not. If the AI is giving you false positives or false signals. So we're seeing that across a number of other themes where having a human in the loop could really enhance the outcome for the customer, and hence they're willing to pay a lot more. And a number of others. Frankly, I'd say across, if we just draw a matrix of functions, sales, finance, customer service, operations, and then verticals. In every function and vertical, we are seeing very interesting opportunities. So it's a problem of plenty right now, and really picking. And then, everyone we pick, there's 10, 20, 30 companies in each also. So the hard part is really getting to know those founders and building conviction. Hey, this is the right one to work with.
Are there any other questions here?
Very interesting perspective that you shared. I think that it's fair. I would guess that everybody here feels like they're far more educated about the AI environment and the investing environment after listening to you. So thank you for sharing your perspective. How can we all help you in your journey to help more founders?
Yeah, thanks a lot for the kind words, and thanks for that offer. Yeah, I'd say a lot of our the connectivity with founders comes through warm referrals. Like I was mentioning, there are just a very large number of deals coming in. So anything that comes with a signal with someone that we trust for that area automatically pulls up. It's just the human element of it, right? There's only so many hours in the day. So if any of you feel that, hey, this is an area I know well, or this is a founder I know well, and based on that, you're saying, hey, this is one of the best founders I know, or hey, this area is a real need in the enterprise because I worked in this space and I think there's a need for a product like this, and here's a company that's doing that. So that's one way we engage with a lot of folks. In fact, I missed mentioning we have at this point about 150 executives and successful founders who are all investors in our fund, and they're aligned with us, and they act as also in this manner, like I'm describing. Often they're sending deals to us, they're advising some of our companies, they are helping us evaluate companies if it's something in the area. So there is, but yeah, I think with the broader network, we always welcome sort of, and then of course, always happy to exchange notes on anything you're seeing, and if it's an interesting company or interesting trends or other things.
Thank you.
Any other questions?
Thank you so much for your time. I was just going to ask, how many of these companies do you think are going to end up being features rather than actual companies, right? It's such a high volume.
Most of them. Most of them. So I think, yeah, just like you said, right, but just by sheer volumes. Like I said, I think put the positive side first. The SaaS era created dozens of companies of scale. There's 100 public companies now that came out of the SaaS wave over the last 10 to 15 years. And we think AI for enterprise will create an order of magnitude more. So there might be few hundred such companies of scale. But having said that, there is tens of thousands of companies right now which are building in this space. So that's just the nature of, Darwinian nature of tech. And that's where we end up spending a lot of that time, going from those 2,000 companies to 5 that we invest in. And then for the founders, I think there's a lot of, I don't know if we have enough time to go through all of that, but a lot of, thinking that goes in right off. You have to have a wedge that's here and now, but then the long-term vision and marrying the two is the hard part. Usually, that's where a lot of the miss happens, right? Like you may be able to solve the problem here today, but then by the time you get to the next level, either it's gotten too complex or you've gone too far down the wrong rabbit hole, or there's too much other noise in the market, or the technology has changed, new layers of technology. So yeah, due to that, I'd say a lot of things will end up as features. If they're lucky, in some cases, they'll just get outcompeted. But I think for the best founders, there's probably more opportunity than ever. So both things are just true simultaneously right now, is what it feels like.
Maybe.
What are some of the most exciting deals that have come across your way lately?
Yeah, maybe I'll talk about uh, my last announced deal that we invested in. It's actually a really hard to pick because there's so much exciting stuff happening. But this one it's called T Robotics. It's a company that there's 4 million installed industrial robots in the world already. So there's a lot of talk about all these humanoid robots, and they're going to do this and that, and I think that'll happen. But what's here and now is this 4 million installed industrial robots in factories, warehouses, a lot of other things. And they're incredibly hard to program and reprogram. So if a robot is programmed to pick this bottle here, and now you want it to lift that can, often it can take a few months, and someone who is writing assembly language code and testing it in different environments and all of that, and it can cost $1 million or more to reprogram it. But this company has these technologists who are 6 PhDs, some of the top experts in their field in robotic control. They built this technology to have a chat GPT-like interface where you just describe it. And in fact, the founder just demoed with PBS recently, where he just had his mother-in-law come and reprogram the robot with a 5-second prompt, just saying that, hey, instead of this, you got to grip this and put this in the machine. And it's able to abstract all of that out and convert that into all of the code. So the market for that is really large because these robots are incredibly expensive and valuable and very hard and expensive to reprogram. So the market pull for that seems really high. So that's one that I'm personally very excited about every time so I was just there at the board meeting yesterday, so that's top of mind.
Cool.
Are there any failures that really surprised you?
Yeah, I think the failures are always painful, and often there's a timing element to it that the same company 2 years later or 2 years earlier would have worked really well. So those have been the biggest. I'd say I'm trying to think about one that I can talk about. Fortunately, at Emergent in the last 7-8 years, I've personally not had a company that has failed. I'm trying to think one from previous era. So there's a company that was my previous firm I'd invested in. It's an idea which made a lot of sense, and it was a company called Y-Plan. And the whole idea was that the event, a lot of events, take a lot of the big conferences, or actually not necessarily conferences, but concerts or a lot of entertainment time events. They have a ton of inventory, which is obviously perishing. Let's say the event happening at 8 p.m. tonight, concert is happening, you have a lot of last minute tickets which get wasted. So they were building this almost like a travel GDS type system for a clearinghouse, that hey, there's someone out there who's actually willing to pay a crazy amount for that ticket, but just matchmaking is not happening. So they built out this app which would let you discover such inventory at last minute. And the whole thesis is also that hey, with Gen Z and younger folks coming in, they actually are they're not that planned. So that's why it's called Y-Plan. So the idea was great. They got a lot of traction on the customer side. The consumers loved it. But they learned the hard way that on the supply side, all the supply was really controlled very tightly by one large player, who I will not name, but you can guess who that is. And that made it really hard for them to get any of the top tier inventory, which these customers were looking for. And they got acquired by Time Out, which is an entertainment company. But I'd say relative to what I would have thought the potential could be, because it's a massive market. There are $10 billion worth companies in that space. Folks like Eventbrite and others in a similar time frame build big companies. But I'd say the key factor there was, sometimes there are these factors which we knew going into the investment, but we thought that they could aggregate enough inventory by going to the rest of the market, which is not controlled by this one player. But then this one player really pulled their weight on a lot of the other part of it as well, which then left just a long tail. which was really hard to sort of monetize at the scale, which was, and the company also raised more money than they should have, and the other elements to it. But yeah, that is one which comes to mind.
All the tough questions are coming more as we wait more.
Let's
Right?
keep them going.
I think we can take two more questions. Are you good? Yeah. Fine. Anybody else?
You mentioned the fact that they raise more money than they should have. How do you identify when you're raising too much money?
Yeah, great question. It's always very, very subjective, and it's a lot of it is pattern recognition over the years. I'd say uh, there's always that when money is easily available. As a founder, and if I were in their shoes, and I've been on the operating side for many years, there's always that hey, we will raise as much as available, and we will spend. And the answer is hey, we will spend lower than that. But that the second part only happens in 10% of the cases. 90% of the cases, the spend just very quickly rises to match what they're able to raise. So I'd say the raise amount often just comes down to, unfortunately, that's how the market is, right? Entrepreneurs have a certain amount of dilution in mind, 15, 20%, depending on which round you're looking at. And if it's a hot market and an entrepreneur that presents well and it looks like an attractive segment, often there is bigger rounds in hot markets than they should. And I think it's a very nuanced, it's very hard to answer. I think it's very specific to, because a company can also have different levels of growth rates based on how much they're raising. So if you're raising 50 million versus 10 million versus 30 million, all of those could be actually right answers for a company. But then the 50 million case may actually be limited by some external factors, like, maybe if in the case of that company, your customer acquisition cost will go so high if you raise 50 million that the ROI won't be there on those. So you can look at those aspects, or you just can't hire people fast enough to grow into that valuation. We look at a lot of those things, and it depends a lot on the specific business. In the case of the enterprise space, the biggest cost is often if it's an enterprise type sales model, it's again customer acquisition, but more in the form of sales and marketing. And often it's limited by how fast they can grow is limited by if they have strong product market fit. This is again for Series B, Series C type rounds. How many salespeople can they hire, train, ramp up, and get efficient quickly, and how many leads can they fill up? And if those two are not balanced, often companies end up wasting a lot of that capital. If they hire too many salespeople, but there just aren't enough customers there, or those leads are not there, they're not able to generate those leads. Those salespeople are not succeeding, and you've lost all this money and time if you raise a lot of money. And vice versa, you have a lot of leads, you don't have enough salespeople. So I'd say you have to look very specifically at the business plan and test a lot of those corner assumptions that are there into that, of where is this capital going to go. And ideally want to raise enough for maybe 24 to 30 months, but not too much more than that.
Practice.
Right. Yeah. I suggest like a 10-10-10 type pitch, that 10 minutes to get to know each other in a somewhat more light touch manner, including the founder asking questions of the investor, which is really important, which 90% of founders don't do, interestingly. Then the next 10 minutes is actually the practice pitch. So practice your pitch to be just a 10-minute version. And then the remaining 10 minutes is for the investor to ask questions. And then, of course, the second two parts could overlap with each other. If they don't have questions, then you save 10 minutes for both parties. But that just keeps it much more, engaging, and it makes it focus on the right parts of the, of the materials. So that's my recommendation.
How important is revenue?
So
How important is
Revenue.
revenue at the time we invest, or in general?
at the time you invest?
Okay, yeah, no, in general it's very important, but at the time we invest, about 60% of our startups are pre-revenue, or at least pre-ARR. Sometimes they may have some pilot revenue or something. So we are not looking for revenue at the time we invest, but we do want to see fairly high clarity to revenues near term. So in our case, ideally we want to see 6 to 12 month path to revenues. And we often take founders to prospective customers from our network and sit through those meetings to get a sense of, hey, is there someone in the enterprise who's actually willing to move mountains and pay for this? And what are they using today? Where will the budgets come from? How will they pass all the security and all of that? So we want to see some near-term path to early revenues in the next 6 to 12 months. Of course, there are exceptions. Some products are really hard to build, and we do a couple of companies or maybe 10-20% of our portfolios companies which maybe are 2 years from revenues at the time we invest. But yeah, we don't need ARR revenues when we invest, but we do want a lot of clarity on how does quick scaling comes once you start having revenues. How will it scale quickly to that, for the first million and then 10 million, the 100 plus, what do those jumps look like?
Let's give a big round of applause.
Thank you.
Thank you, Anupam.
Thanks a lot.